Breaking news. Two major U.S. banks have just failed. Are your savings and investments at risk? Don't panic, because in this video, we're going to tell you exactly what you need to do to protect your money and make smart financial decisions in these uncertain times. Stay tuned and get ready to take action. In a worrying turn of events, two prominent banks that had a strong foothold in the tech industry have collapsed, triggering a bank run and prompting government agencies to take emergency measures to safeguard the financial system. President Joe Biden has been quick to assure Americans that their money in banks is safe. The current situation bears an uncanny resemblance to the financial crisis that stemmed from the housing bubble bursting 15 years ago. Except this time the pace of events seems even more frenetic. Don't forget to subscribe to our channel and hit the notification bell to watch our latest videos as soon as they are released. In a span of just 3 days, the U.S. government has taken control of the two banks that were at the center of the collapse, with Silicon Valley Bank, headquartered in Santa Clara, California, experiencing the largest bank failure since Washington Mutual's demise in 2008. So, the first question that comes to our mind is, why did the Silicon Valley Bank fail? Silicon Valley Bank, already reeling from a tough period for technology companies, was dealt a fatal blow by the Federal Reserve's ambitious interest rate hike plan to tackle inflation. The bank had invested heavily in treasuries and other bonds, a common practice among financial institutions since they are perceived as low-risk investments. However, the bonds' value began to decrease as they were paying lower interest rates than newer bonds issued in the present high-interest rate environment. Comment recession if you would like us to make more videos like this in the future. Ordinarily, this would not be a cause for concern since bonds are considered long-term investments and banks are not required to report declining values until they are sold. In fact, these bonds are not sold at a loss unless the bank is facing an emergency and requires immediate cash. Unfortunately, Silicon Valley Bank found itself in a dire situation. Its clients primarily consisted of tech-focused startups and other companies that required more cash in the past year, resulting in a significant withdrawal of deposits. The bank was forced to sell a large portion of its bonds at a substantial loss, and as the news spread, the pace of withdrawals increased, ultimately rendering Silicon Valley Bank insolvent. What did the U.S. government do to tackle the situation? Following the collapse of Silicon Valley Bank and New York's Signature Bank, the Federal Reserve, the U.S. Treasury Department, and the Federal Deposit Insurance Corporation (FDIC) made a crucial decision to guarantee all deposits at these banks, including those exceeding the $250,000 limit on insured deposits. This move was crucial since many of Silicon Valley's startup tech customers and venture capitalists had deposits that far exceeded the insured limit, leaving as much as 90% of the bank's deposits uninsured. Without the government's backing, many companies would have lost their funds, making it difficult to manage their finances. Don't forget to like this video if you've watched it till now, as it inspires us to make content like this. The purpose of these expanded guarantees is to prevent bank runs, which occur when customers quickly withdraw their funds, by establishing the Fed's commitment to safeguarding the deposits of both individuals and businesses, thus calming fears during a challenging period. Late on Sunday, the Federal Reserve implemented an extensive emergency lending program intended to restore faith in the financial system. Banks will be permitted to borrow money from the Fed to cover any potential customer withdrawals without being forced into money-losing bond sales that could jeopardize their financial stability. Such sales were what triggered Silicon Valley Bank's collapse. If all goes as planned, the emergency lending program may not have to lend much money. Instead, it will reassure the public that the Fed is committed to protecting their deposits and is willing to lend significant amounts to do so. There is no cap on the amount of borrowing that banks can do, except for their ability to provide collateral. So the question arises, how did the banks end up with such big losses? Interestingly, a significant portion of the staggering $620 billion in unrealized losses can be attributed to the Federal Reserve's own policies aimed at curbing inflation over the past year. By rapidly increasing its benchmark interest rate from almost 0 to about 4.6%, the Fed has indirectly pushed up the yield or interest rate on various government bonds. particularly 2-year treasuries that soared to over 5% until recently. The arrival of new bonds offering higher yields reduces the value of existing bonds with lower yields if they are sold. Banks are not required to recognize such losses on their books until they sell these assets, which is precisely what happened to Silicon Valley Bank. So, will these government-backed programs spend taxpayers' dollars? When a bank fails, the Federal Deposit Insurance Corporation (FDIC) is legally required to take the cheapest possible route to wind it down. This means that only the first $250,000 in depositors' accounts are covered, leaving many customers in Silicon Valley Bank and Signature Bank at risk of losing a large portion of their savings. However, in this case, the FDIC went beyond this cap and guaranteed all deposits in the two banks due to the systemic risk posed by their failure. The decision was made unanimously by the Fed's 6-member board, with the FDIC and Treasury Secretary agreeing to it as well. The U.S. government insists that this guarantee won't require any taxpayer funds and will be replenished by levying an additional fee on banks. Nevertheless, some analysts fear that this could ultimately fall on small banks and Main Street businesses, leading to long-term costs for consumers and businesses. Now, the final question is, will it all work in the end? According to analysts like Bal Krishnagua, the government's response to the collapse of Silicon Valley Bank and Signature Bank is significant and should stabilize the banking system. However, the stock prices of medium-sized banks similar to those that failed have plummeted. Guha believes that the government's actions, which include guaranteeing all deposits and initiating an emergency lending program, will prevent bank runs and restore stability in the coming days. Neil Ashworth, an economist at Capital Economics, agrees that the lending program will allow banks to weather the storm. However, Ashworth warns that contagion is often fueled by irrational fear, so there is no guarantee that the government's efforts will be successful in preventing further bank failures. For example, even though the government's response to the 2008 financial crisis was significant, it wasn't able to prevent the collapse of Lehman Brothers, which sparked a financial meltdown.